Hi everyone, and welcome back to my channel. This is the second video that I've recorded for my financial accounting section, and today we're going to be talking about taxes, which I know is not the most exciting topic, but I'll try to make it good for you guys. This material is not covered in your textbook, so you should look at the lectures and handouts posted on Canvas. I'll be going through the most important points today, and I'll also try to show you what questions might look like. When I took this course, I made a Quizlet to help me study, so I'll put that on the screen somewhere, and I'll also link it in the description so you can use it too if you'd like. I'm hoping this video is better than the last one, and with all that in mind, let's get started. For taxes, the first thing we're going to cover is types of taxes, and these are types of taxes in the United States. Obviously, they are different across countries, but we're going to be focusing on the US. So in the United States, there are income taxes, which I'm sure you're all familiar with. You have to pay taxes on your income, and we'll break that down further later. And that's at the federal, state level, local level. There are property taxes, and property can mean real estate, so like homes, but it can also mean personal property like cars. There's a wealth transfer tax, and that's broken up into estate taxes and gift taxes. Gift taxes we'll talk about later, but the tax is based on the value being transferred. And I made these slides a few years ago now, but during that time the estate tax went up to $11 million in the new tax law, and the implication is that when you die with illiquid assets, it's problematic because you're expected to pay millions on the value being transferred, so you'd either have to sell property, take on debt to pay the government the taxes that you owe on that value being transferred. There are sales taxes, which I'm sure you have paid, and they vary across states. There are excise taxes, so those are taxes on specialty items, and those can be gasoline, alcohol, cigarettes, resort taxes, etc. And then there are various miscellaneous taxes, such as unemployment, Social Security, intangibles, stuff like that. So who pays taxes? Obviously, individuals pay taxes. I'm sure you've paid taxes at some point. Corporations pay taxes, and there's a unique phenomenon with corporations called double taxation. So basically what that means is corporate earnings are taxed to get to their net income, and then they pay dividends out of their net income, which go to investors, and then investors have to pay taxes on their investment income. So basically those earnings are taxed twice, but we'll go over that again in Chapter 13 in more detail. There is non-grantor type trusts that pay taxes. You don't need to worry about this at all, but just in case you were curious. Estates pay taxes, as we just said, so estates are separate entities that pay taxes on their earnings. The reason the estate tax was enacted was because wealth was being transferred through generations with no taxes, so it helped the really, really rich stay really, really rich. But now, when a person dies, they owe a lot of taxes before the money can be given to the family. And then we know from Chapter 12 that flow-through entities pay taxes, so if you remember, that's partnerships, LLCs, stuff like that, and there's a few others here, S-corps, LLPs, and grantor-type trusts that you don't really need to worry about. Tax history is pretty important, and I would know this slide. There's three main dates you should know. First, in 1862, the first income tax was pushed through Congress by Abraham Lincoln, so it was Abraham Lincoln, and he implemented it to pay for Civil War and debt expenses. So war is expensive, taxes raised money from citizens, and they used it to cover debt expenses related to the war. However, in 1895, the income tax was declared unconstitutional because people really didn't like paying taxes. But in 1913, the 16th Amendment reinstituted the income tax, and we've had it ever since. So important things here. Abraham Lincoln got it implemented in 1862 to pay for the Civil War and debt expenses. In 1895, it was declared unconstitutional, but then in 1913, the 16th Amendment reinstituted the income tax. So, tax structure. It's important to know that taxes involve the legislative, judicial, and executive branches of the government. So it's the interplay of all parts of the government. With interplay being the key word, they all work together. U.S. income tax law is enacted by Congress. So every year Congress modifies the tax laws. Usually small changes can be really large changes, and all of the changes can be found in what's called the Internal Revenue Code, the IRC. So Congress is responsible for enacting tax law. And Congress is the legislative branch, in case you're not from the United States or anything like that. Next, the Department of Treasury writes regulations that interpret and explain the IRC. So what you're probably familiar with is the IRS, known as the Internal Revenue Service. And the IRS provides additional guidance and basically tells you what you can and cannot do. So they do this, they have that process, they tell you what you can and cannot do, and then they are known for audits. So those are investigations into tax payments. So if anything looks suspicious or something looks irregular, they investigate it and see if something's going on. And then taxes can be appealed to the Supreme Court, so that is the judicial branch. Okay, so this section here is a lot of what you'll be tested on, so I'm going to go through it pretty thoroughly. First thing is what counts as income. So income includes cash, property, or other increases in wealth according to Section 61 of the IRC. So Section 61 of the Internal Revenue Code defines income. So it's defined as income from whatever source derived. So it can be cash checks from work, capital gains from investments, all sorts of things. So income is not only cash, it can come from a variety of sources. And then income is taxed, which you know, and taxable income is defined as income less deductions and less adjustments, which I'll go through with you later. However, there are some items that are non-taxable, so you don't have to pay taxes on them. And basically, I'll show you at the end, but there will be some scenarios, and you'd have to determine if it's taxable, non-taxable, an itemized deduction, an adjustment, stuff like that. Okay, so we're going to start with the non-taxable items and get those out of the way. So the biggest category of non-taxable items is employee benefits. So benefits can be life insurance, health insurance, transportation fees, anything like that. Employee benefits are not taxable. The next thing is gifts, which I told you we'd talk about later. We're talking about it now. So you don't have to declare gifts. They are non-taxable as long as they are $15,000 per year or less. So if you just receive like a $500 gift or even less than that or even a little bit more, you don't have to declare it, you don't have to pay taxes on it, it's fine. But if you were to receive a $20,000 gift from someone all at once, you would have to pay taxes. So that's important to note. I know Frank always goes over it in class, but he tells you little ways to get around it. So it's per person. So if both your grandparents wanted to give you $10,000 each, that would be a way to get around that if your grandparents were giving you a gift. Inheritance is non-taxable. So if someone dies and leaves you something, that does not go in your tax return. Moving on, disability income is non-taxable, but only if you are the one paying the premium. If your employer pays the premium, then it is taxed. So non-taxable if you pay, taxable if your employer pays. Workman's compensation, so that's when you get hurt on the job. Any income you receive while out of work is not taxed. Child support is not taxed, so you would get the full amount given by the other party, which makes sense. You wouldn't want to reduce that amount. Life insurance proceeds are not taxed, so if a person dies, you don't have to pay income taxes on the payout from the insurance company. You get the full amount of the policy for that person. Income from state obligations, Frank said it that way, but in case you weren't sure what that meant, that usually refers to municipal bonds. That's one of the reasons people like municipal bonds in the first place, is because they're not taxed. And then welfare benefits are paid out from the government to individuals based on need, and those are not taxable because they're clearly going to individuals with a lot of need, so there's no need to impose additional taxes on top of that. So all of those are non-taxable. Taxable items, by definition, would be everything I didn't just say. So taxable items are essentially everything that wasn't identified as non-taxable. But we're going to go through a few just in case, because sometimes it isn't exactly obvious what would be taxed. So wages and any earnings you receive from your job are taxable. Found items are taxable, so anything you find, you're technically supposed to declare and pay taxes on it. So as a hypothetical, if you found $10,000 on the street, you're supposed to declare and pay taxes on it. Obviously, the majority of people would not do that, but technically you are supposed to. Dividends and interest are taxable, so any earnings on your investments are categorized as investment income and they are taxed. If you win the lottery, you have to pay a significant amount of taxes on your prize, which really decreases the value of it. Continuing on, sales of property, you do have to pay unless you are selling your personal residence and what you earned is less, let me re-say that. So, sales of property, if you are selling your personal residence, you don't have to pay taxes unless you earn over $500,000 from the sale. Otherwise, you'd have to pay capital gains on money earned from selling real estate. So, what that means is, if you're selling your personal residence, so it's your house, you don't have to pay any taxes on the sale of it unless you're earning over $500,000 from the sale. So say your house, you originally bought it for $200,000 and then you sell it for, let's say $900,000 and you made $700,000 on it, then you pay taxes. But usually you wouldn't make that much on a sale. So if it's less than $500,000 on your personal residence, you don't pay taxes. But if you are like a house flipper or something like that, you do have to pay capital gains on the money you earn from selling it, because that's technically your income if your job is like house flipping. So that covers sales of property. Illegal sources, another one, they probably don't pay taxes, but technically they are supposed to if you're engaging in any sort of illegal activity. Gambling, you pay taxes on any earnings. Unemployment compensation usually trips people up. That is taxable. And then bartering, so the value of what you trade for should be on a tax return. So that covers all the taxable items. And then we're going to go over itemized deductions and adjustments. So first, itemized deductions are subtracted from net income before you pay taxes. So basically what that means is it reduces your amount of net income so you pay less in taxes. However, most people don't meet the threshold to use itemized deductions. Instead, they may use a standard deduction because most deductions are only possible if they make up a certain percentage of your income. And I'll explain what that means in a second. So there are a few major classes of itemized deductions. The first is medical and dental. So if you receive medical care and it accounts for 7.5% or more of your income, then you can claim that as an itemized deduction. So obviously 7.5% of your income is a lot. So maybe you had a really long hospital visit or you have medication that's really, really expensive. Then you could claim that as an itemized deduction. But if it's just like a normal doctor's visit or something like that, that is not an itemized deduction. Next is taxes, and you might be a little bit confused, but this refers to state and local taxes that you pay, and the highest amount you can deduct is $10,000. Continuing on, interest you paid, that refers to usually mortgage interest on your primary residence, so that's interest that you're paying on your house. Gifts to charity is the main one here. So first of all, it has to be what's called a 501c3, and a 501c3 is a legitimate organization recognized by the IRS as a charity, and if you donate to it, it can be a deduction. So gifts to charity is usually one that they ask about a lot. And then casualty and theft losses can be deducted if they make up a certain percentage of your income. You don't need to know or worry about the percentage, but casualty and theft losses can also be deducted. Job expenses, so job travel, union dues, job education, as long as your employer is not paying for it, can be deducted if they're over 2% of income. And then tax preparation fees used to be deductible, but the new tax law abolished this, so they are not deductible any longer. But they used to be. So that covers itemized deductions. And then adjustments. So adjustments are subtracted from total income, just like itemized deductions, to establish adjusted gross income. And then that is what is taxed. So just a few examples. First is individual retirement accounts, which I'm going to discuss on the next slide, but any contributions to IRAs are adjustments. Alimony payments, so what alimony is it's a periodic predetermined sum awarded to a spouse or former spouse following a separation or divorce. Those are also subtracted from total income to get adjusted gross income. And then self-employed health insurance or self-employed tax. And that altogether covers taxable, non-taxable, itemized deductions, and adjustments. So now we're going to go into more miscellaneous type topics. So the first, like I just said, is retirement funds and taxes. So first of all, down here, in case you weren't familiar, an IRA is an individual retirement account, and a 401k is a retirement account at a company. And there's a difference between Roth and regular. So speaking in terms of an IRA, a Roth IRA means that the money you put into the retirement account is post-tax income. So you already paid taxes on it. That's what post-tax income means. So when you take it out when you retire, you don't have to pay taxes on it because you already paid them before you put it in. And then a regular IRA or 401k, so this is regular. Money that goes into retirement fund is deducted from gross pay. So it's pre-tax income, and this is what I was referring to up with the adjustments. So when you take it out when you retire, you do have to pay taxes on it. So just to break that down again, Roth means that it is post-tax income. Going into the account, so no taxes when you take it out. Otherwise, if it's a regular one, it's pre-tax income, so the contribution is an adjustment. And when you take it out, you do have to pay taxes. So that is the difference between a Roth IRA and a regular IRA or a 401k. And that is the link. So this is the one that would be an adjustment from above because it's going in before taxes, so it reduces your income that you pay taxes on. Moving forward, other miscellaneous things to know. Education and taxes. So 529 plans are education funds, and if you put money in them, they are not taxed on the interest the fund earns, and this is basically to promote higher education. And we'll go into later how tax law can be used for social change. Next is capital gains. So Frank makes a point of saying that people should try to make ordinary income into capital gains, and the reason is because capital gains are taxed at a much lower rate. So again, I made these slides now, I think 2 years ago maybe, but at the time, the maximum federal tax rate on ordinary income was about 40% compared to only 20% on long-term realized capital gains. So the takeaway is that the tax rate on capital gains is much lower than the tax rate on regular income. And you should know that. So as I was just saying, taxes and social change. The main purpose of taxes is to generate revenue for the government. But over the years, tax law has been a very powerful tool for social change as well. So the main purpose is to generate revenue. That's why people pay taxes, for the government to use that money for various purposes. But tax law can also be used for important social change measures. Sometimes powerful lobbies are able to convince Congress to pass certain laws through, so maybe different types of excise taxes. So a common example is a tax on cigarettes. The tax on cigarettes is meant to reduce smoking, and that's a measure of social change because smoking is bad for you, so a tax on cigarettes helps reduce smoking. And obviously we just talked about education and 529 plans. Not taxing the interest earned on those 529 plans promotes higher education, and that's also an important social change. And then finally, we have tax avoidance versus tax evasion. You should absolutely know this, it's very important. Tax avoidance is the arrangement of one's financial affairs to minimize tax liability within the law. So key phrase is minimize tax liability within the law. So this is legal and perfectly okay. And there's a quote on the handout, and it says, every citizen has a constitutional duty to pay the least tax. So basically, this is just arranging your financial affairs in such a way that you pay as little in taxes as possible under the law. And it's in your best interest to do this because if there are ways for you to pay less in taxes, you should take advantage of them. Tax evasion, on the other hand, is the non-payment or underpayment of taxes, and this is illegal. So this is very bad. People go to jail for this, so that's why it's very important to know the difference between tax avoidance and tax evasion. Tax avoidance is legal. Tax evasion is illegal. So that's either completely not paying your taxes or paying way too little in taxes, whereas avoidance is paying the least amount possible in taxes, but abiding by the law. So that covers all of the content, and then these are just practice problems based on the taxable, non-taxable, itemized deduction, stuff like that. So on the exam, you might see scenarios like this, and you would have to identify what they're categorized as. So if the first one is a gift from your grandparents, we would think, okay, that is non-taxable, because we know gifts are non-taxable, and we would assume it's under $15,000. And you can make that assumption on an exam that a gift would be under the required amount. So a gift from your grandparents is non-taxable. If you found a gold necklace deep sea diving, technically that is taxable. That's classified as a found item, so even though you might not want to claim it, technically you're supposed to claim that and pay taxes on its value. Hospital expenses would be an itemized deduction, assuming it's over the percentage necessary. And again, on exams, if it's saying things like this, you can assume that it is over the percentage necessary. Next, a donation to the American Civil Liberties Union, known as the ACLU. That is a nonprofit and it is a 501c3, so this is an itemized deduction because this is a 501c3. If it was not a 501c3, then it would not be. Employee benefits, so including health insurance, that is non-taxable. That's one of the largest categories of non-taxables. And then unemployment compensation, we know that that is taxable, and that's the one that's tricky sometimes because you wouldn't expect it, but unemployment compensation is taxed. So there you have it. That is your review of all the information, all the most important information related to taxes. Per usual, if you have any questions at all, please feel free to reach out and message me, and I'd be happy to answer any and all questions. Hope you all have a great rest of your day, wherever you are.